After a brutal late session sell-off on Tuesday, likely powered by foreign investors, stocks bounce back. Realty, healthcare and auto lead the charge. Consumer durables and energy bring up the rear. Mid-cap index gains in line.
Nifty Bank is expected to post a sizable loss in Q4 on the back of weak business momentum, tighter margins and elevated credit costs, but the biggest concerns are over any fresh revelations.
Dixon Tech misses the mark on revenue on stagnant mobile sales and weakness in consumer electronics and home appliances, but the company aims to more than double revenues in the next 2 to 3 years with 90 to 100 basis points margin improvement.
Oil flares up on reports of a possible Israeli strike on Iran, the OPEC's third largest producer. Fears of Iran disrupting movement in the Strait of Hormuz and lingering uncertainty over the Russia-Ukraine war also add to the mix. Hello and welcome to Halftime Report, live from the CNBC-TV18 Motilal Oswal studio. I'm Ekta Batra and with me is Mangalam Malu. Well, it's turning out to be a good session for the markets. It's at least stable at this point in time. We have the Nifty at around 24,800. Let's see whether we manage to make a dash towards 25,000 or not. But for the mid-cap index, also holding with a gain of around 256 odd points, and the Bank Nifty just about higher by around 0.16%, consolidating with a positive bias. A lot of stocks in focus on account of news, and that's what we'll be focusing on in the next 60 odd minutes. Hi, Mangalam.
Hi, Ekta. Thanks a lot for that. Yesterday was a bit of an excess on the way down, and today at the start was a bit of an excess on the way up. Now we're, what do you call it, coagulating around that 24,800 mark for the Nifty. And we're looking at 200 points on either side for the frontline index right now, 24,600 to 25,000 itself. The Nifty Bank, which was powering up ahead, has seemed to come off a tad from the highs. And we have the mid-cap index as well, which, while is gaining in line with the frontline indices, has come marginally off the highs. So where we close today will be a lot more important than how we opened and how we performed so far. A couple of things really stand out. The metals pack continues to do well for the second day running. Maybe prospects of better Chinese economy, helping their cause. And the other part is the IT index, which also did slightly underperform in yesterday's trading session, has made a bit of a comeback today, whether that sustains or not. But amidst all of this, there are a bunch of result reactions that we're tracking. Texmaco Rail and Engineering is the first management on the show today. Reported a steady set of fourth quarter numbers. The revenues, came in around 17% higher year on year. We have Sudipta Mukherjee, who's the MD of Texmaco Rail and Engineering, joining in. Sudipta, the first 3 quarters of the year, you did a lot better. The last quarter, while the revenues grew, the percentage of growth actually slowed down. In light of this, what is it that you can guide for in FY26 when it comes to revenues and margins? Also, if you could give us a sense of what kind of order inflow are you targeting for the next financial year?
Good afternoon, Mangalam and Amraj. Thanks for having us. I think Texmaco has put up a very strong performance while our revenue has grown over 46% and the EBITDA was 58% higher year-on-year basis. And if you see the PBT, that's also 112% higher. So in a sector like railway, one should not look at things on a quarterly basis. It is on a year-on-year. If you see that we have significant growth which we have put up as a company, and we foresee, of course, we are confident that we will continue with this momentum of growth, and while in the journey will definitely improve few key ratios of the business significantly.
Okay. Could you just give us a sense in terms of the tenders from the Indian Railways in FY25? We do understand that it wasn't that much. We didn't see many large tenders. What is FY26 looking like?
Umraj, if you kindly analyze, if you kindly recognize the fact that Indian Railway first time came up with a long-term contract 2.5 years back. And it is in the history of the Indian Railway and the government of India's push for a long-term plan and development for the country to become the third largest and second largest economy. So consequent to the National Rail Plan, the largest tender was awarded. So no one can expect that every year such kind of tender will come. And the delivery period of that tender was, of course, up to 2025-26. So everybody is sitting, I mean, at least Texmaco is sitting on a significant order book in spite of the fact that last year, whatever be the performance, and perhaps we are the highest supplier of rolling stocks to Indian Railway, and that is very much within the timeline of the mandate which we had as per the contract. And there has been few specific tenders in between, and which was more because, you know, in this budget, government had a more focus on the removing the track congestions and add on the infrastructure part of it. So there were certain specific rolling stocks which started coming in. We have also got a share of that contract, and it's going on. And we envisage that very soon there will be further contracts which will be awarded, or tenders will come up. So for the conventional rolling stocks are concerned. And just to briefly appraise you that Texmaco is very uniquely placed because of its very good joint ventures with global conglomerates. And we had been one of the pioneers in, propagating for the technology and advanced products. And we are very happy to learn that government is looking forward for optimum solutions and more advanced railway wagon design, including the components and the bogies, and which as a company we are really looking forward to, because we are very uniquely placed and robustly placed to get into that. Other than the infrastructure and all other things whichever we are doing, we'll be continue to focus on those signaling system solutions and many other parts.
What about execution for FY26 and the revenue that you're likely to recognize? Because FY25, like you pointed out, you did 46% growth in the revenue, 77% growth in the EBITDA, which implied a 200 basis points, near 200 basis points margin improvement. Do you think this 35 to 40% sort of revenue run rate is sustainable for FY26 and beyond as well? And what levers do you have for margins going forward? Do you think you can manage them between 9 to 10%, or there is a possibility that it sustains above 10%?
So, Mangalam, as I have mentioned that, of course, it cannot be, the growth will be sustainable for Texmaco. We believe if you recognize that what are the various parts of, various segment of business of Texmaco. One is the primarily the freight car division, which includes the component part of it. And we have this electrical part of the infrastructure. And then we have the rail infrastructure system and solution. So, so far what you have seen is the growth which is in the core business, which remained as a core business for the company in and around freight rolling stock. We feel that there is enough room for us to grow there, because we are very technologically advanced and very uniquely poised so far the domestic market is concerned. And perhaps we are the only company in India who are significantly exporting the freight rolling stocks and its components. So we believe that there is enough room for growth in that segment. But what I can also assure you that we have a very focused approach to grow the electrical engineering part of it and the rail infra system and solution, which is going to get demerged from the company as a wholly owned subsidiary. And with government push on and huge financial allocation in rail infra and the signaling part of it, we feel with our kind of qualifications we have, and with the focused approach and this management restructuring, and that business has a huge potential to grow, and it have a potential to be mirrored in a very near time.
Okay, all right. Just a quick last question then. You did tie up, you've entered into 2 partnerships in Q4, which is with a European firm and a leading US company as well. What will that bring to the table in terms of revenue for you?
So if you see that our revenue growth in terms of the numbers, if I have to mention of the turnover, it is around 8, it remained 8% of the revenue, but it has significantly growth in terms of the value. And we have been the one of the company who has all the accreditations to supply materials of freight rolling stock and castings to US market. And Trinity is one of the largest rolling stock manufacturer of the world. And Texmaco and Trinity is poised to set up the first of its kind global capability center in India. And you know that the whole world is thanks to the government of India's initiative and to all the Indians and all of us, that everybody is looking at us as a potential supplier for the global requirements on a sustainable basis, who are very uniquely placed in terms of cost advantage, and of course we are neutral. So more and more companies are coming towards us. So this initiative of putting up a global capability center in Delhi will also have a component called global supply sourcing. So that is an aggregation business for the rolling stock for the world. So one part will look for the innovation and technology upgradation and bringing new designs for India as well as the rest of the world, where we want to fight with the global major today, maybe, which is perhaps CRRC, and
Sure.
Then of course to fulfill the dream and work better out of India, being a global sourcing partner for the US market and rest of the world.
All right, we're going to leave it on that note. Thanks very much for joining in and speaking with us and giving us that perspective. So that's Texmaco Rail. The company has indicated that they have a healthy order book. The stock, as you can see, is up around 0.3%, and they will continue to focus on signaling solutions. They do have an export outlook as well. We'll take a short break, but up next, the management of Acme Solar Holdings will be joining in to talk about their Q4 performance. Stay tuned. Welcome back. Well, for the markets, it's holding up with a gain, but the bank Nifty is now slipped into the red, so just watch out for that, down around 66 odd points. We have a lot of the pharma stocks which are gaining today, so Cipla is up around 2 odd percent. They did launch a complicated UTI drug, or a drug which is used for complicated UTIs in the Indian market. But separately, Sun Pharma is coming out with its numbers tomorrow, so that one is holding up with a gain of around 1.6%. And Divi's Labs came out with its numbers already, so we're seeing some amount of buying there, so up around 1.5%. Some defensive flavor really playing out in the markets, so probably why you're seeing a lot of these pharma stocks gain. But in any case, let's talk about one particular company. Acme Solar Holdings is the next management on the show. The company reported what was a strong set. Revenue and EBITDA margins came in healthy. Do note that Q4 did see a one-off exceptional gain of 697 crores. To discuss this and more, we have Nikhil Dhingra, who's the CEO of the company, joining in. Mr. Dhingra, thanks very much for taking the time out. If I can just start by talking about the capacity, at the end of FY25, it stood at around 2.7 gigawatts, and it's doubled from FY24. You do have plans of increasing it to 7 gigawatts by FY28. Tell us if it is achievable and your eventual target of 10 gigawatts by 2030.
Sure. So in terms of the one correction I would like to make before we started, you mentioned that there was an exceptional profit. That exceptional profit happened in FY24. This year, FY25, we didn't have any exceptional profit. So FY24, we had exceptional profit. So the growth you see is much more exceptional if you adjust for that in the FY24 numbers. And in terms of the this year, we have expanded our capacity from 1.3 gigawatts to now 2.7 gigawatts since we commissioned a plant last week. And of course, this is slated to go up 3 gigawatts over this quarter and next quarter. In terms of moving to the 7 gigawatts operational capacity, as you know, we are in the long-term PPA business. We have contracted capacity with the central government of India, wherein we have to build the plants in those 2 years. So all our commissioning are driven by the PPA signing, which are there with the central counterparties for 25 years. So they have slated staggered commissioning timelines. Some is concentrated around May, June of 26, and some of them are concentrated around December 26. And the last phase is, you can say, around May, June of 27. So these are the timelines where we will go from 3 to 5 gigawatts of contracted capacity. And another thing is, with our contracted capacity is, since we are doing a lot of FDRE projects and hybrid projects, the installed capacity number is much higher than the contracted capacity numbers. So when you are looking at these numbers of 7 gigawatt, the installed capacity will be much higher in terms of the installed capacity, because in an FDRE, typically you install 2 megawatts for a single megawatt of contracted capacity. In terms of the 10 gigawatt, of course, this 7 gigawatt target is for calendar year 27, reaching that operational capacity. And we do have all the PPAs in place, which is the first thing, the connectivity in place. We have around more than 50% of land for solar and 60% land for the wind we plan to do for these FDREs. And we have tied up the long lead items for the capex. So we are on track to execute these projects. We do have the financing in place for the signed projects. So that's how we are doing it. And this is a very stable business in terms of the post-operational cash flows. From reaching from 7 gigawatt to 10 gigawatt, of course, we need to win only 3 gigawatts more of projects in the next 2 years to reach that capacity. Because once you win the project, it typically takes 2.5 years adjusting for PPA signing. So we are well likely to exceed the 10 gigawatt of operational capacity target by 2030.
Well, that is quite heartening. You will exceed the 10 gigawatt capacity by 2030. You'll probably do that in advance as against the earlier target that you had. If you could give us a sense of how this EBITDA ramp up will take place then, because from the capacity jump, the EBITDA jump will obviously be a lot more because of the operating leverage, and at the same time the rates, which may be slightly higher than what you had earlier written them for. I remember you had said that average tariff is 3.5 per unit for the 2.5, 2.7 gigawatt capacity that you have, and bulk of the built-in capacity that you are, the capacity that you're building is likely to be bid between 3.5 to 4 rupees per unit. Can you give us a sense on how that is panning out, what your current realization per unit is, and what in increased capacity will the realization be, and as a result of which what your EBITDA is likely to grow? Because I remember that 7,000 crore target by 2030 you said is easily achievable.
So, in terms of you have a very good memory. So I think the 3.5 is the average tariff for our operational capacity. You are indeed right. And the average tariff for the under construction capacity is around 3.9 to 4. So you're right that the average realizations will go up, and also the per unit generation for a megawatt of contracted capacities goes up. Because the capacity utilization factor for solar currently we are at around 25.6%. We have increased it by 200 basis points this year. In an FDRE, typically the CUF will be 45 to 55%. So that effectively for a contracted capacity generates that much revenue by a factor of around 1.8 to 2 times. So so definitely in terms of the EBITDA expansion, you are right that there is an operational leverage in this business. And in terms of the capital efficiency, if you look at our ROEs, ROC, we have industry-leading ratios on that. So when we look at the revenues and EBITDAs, of course, this year we did around 90% EBITDA margin, improving on the last year. And that is, of course, resulting from the higher capacities of our plant. The cost from revenue to EBITDA is typically your O&M cost. And the larger your plant is, single location, the lower your costs are. So that is one bit of leverage. And of course, the other bit of operational leverage is the same sort of EPC team is able to build out larger capacity if you do larger plants on single location. So that will play out, of course, because most of our sites are upwards of 500 megawatts each. In some places, we are building more than a gigawatt. So that is because we have been able to gather connectivities and the PPAs required to get those connectivities at the appropriate locations, high radiation locations for both solar and wind. In terms of the EBITDA numbers, they will grow very steeply as we execute from 3 to 5 to 7. Of course, our capex also will go up in sync. And the key thing for us is, other than the EBITDA margins, is the return on capital employed, because this business is basically linked to that. We are not only after the P&L, we are equally care for the ratio of P&L and balance sheet. So definitely the numbers will be in terms of the PPAs we have, that number, of course, is something we will try to achieve.
So 7,000 crore happens before 2030, your target, because 10 gigawatts happens before 2030 as well.
Yes, it of course, in terms of the exact revenues and EBITDA, of course, EBITDA is 90%. So as we go to the 10 gigawatt target, there'll be a steep jump in our revenues. Right now, we are at around 2,200 crores annualized sort of revenue. As we grow our capacity 3 times, and that too at a higher tariff, it will be definitely possible.
And just quickly, what would this do to your balance sheet, your current net debt, and what would it rise to, or how would you manage it? Just a quick question as you increase capacity.
Right. So this business is capex intensive. So the key thing for us is how quickly we are moving from taking debt to getting the capacity operationalized. And the other thing for us to look at is in terms of what is the net debt to EBITDA number for our operational capacity, and what is the net debt to EBITDA number on the let's say next 12 months EBITDA we are targeting for operationalizing capacity. So we have a stated target that we will never cross a debt to EBITDA of 5.5 on the operational capacity. As far as under construction capacity goes, we have a typical 2-year execution period for a project. The first year we don't draw any debt because we do land, transmission line, and we do the project with our equity contribution. The rest of the debt contribution comes in the second year. And that EBITDA starts coming up after 12 months of the debt incoming. So we will always try to be within the band of debt to EBITDA of 5.5 for the operational assets.
All right, Nikhil, we're going to leave it on that note. Thanks very much for joining in and speaking with us. Well, we need to take a short break, but here is some good news for our viewers. India's business news leader is now just a click away, introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or Google Play Store, or just scan the QR code on your screen.
As we speak, the Nifty Bank has moved back into the red, so we'll keep an eye out on the decline that we're seeing from the highs. The frontline indices, as we speak, there have been some recovery from yesterday's lows, but that has been sold into. Where it goes from here is the most important thing to watch out for will be what happens to the mid-cap index from here, because the market breadth, there were more stocks advancing than the number of stocks that were declining. Now those lines have come fairly close and on the verge of intersecting. And, it's a pretty even keel in terms of the number of stocks that are advancing versus the stocks that are declining. 24,800 call writers have covered their positions, as have the 25,000 call writers, telling you that maybe on the way up, we can see some moves, but we're also seeing some writing at the 24,800 put and the 24,700 put, telling you that the supply on the way up will find demand at around 24,700 to 24,750. Yesterday's low, extremely crucial. The Nifty put call ratio, which had gone to levels of 0.69, has now moved higher to 0.8. And the Nifty Bank, which was above its 20-day moving average, has now fallen once again below its 20-day moving average of 54,990. So let's see where it goes from here as well. Titagar will enter F&O ban after exiting it yesterday, as will Dixon, with the kind of up move that we're seeing on that stock. With that, let's take a short break. On the other side, more markets and stock-specific action.
Welcome back. Well, Schloss Bangalore, which owns the Leela Palaces Hotels and Resorts, will be hitting the Lal Street with its 3,500 crore IPO on the 26th of May. Brookfield-backed company aims to reduce its debt by around 23 crores through its IPO proceeds. Our colleague Reema Tendulkar caught up with Ankur Gupta, who's the managing partner, head of real estate for Asia Pacific and Middle East at Brookfield, to discuss the IPO offerings, and began by asking him, when will the company become profitable? Listen in.
In 2019, what we acquired was this very unique business which needed experience, which needed growth, which needed stability. And very proud that in 5 years, through a period of a lot of global turmoil in the hospitality sector, the business today is bigger by almost 3 times. It has an amazing appeal internationally. It has been ranked as one of the best hotel brands in the world consistently for several years. And I would like to believe that the best years, through the effort that we've put into this business, are still ahead of the business.
So will it be profitable from here on?
The Leela business recorded an EBITDA of more than 700 crores in FY25. And as I said, the best years are still to come.
You're bringing down your debt. You've earmarked about 2,300 crore to bring down your debt. What will the debt number stand at now?
The net debt number post...
After?
Yeah, so the net debt number post the IPO will be almost zero, which was our strategy for the IPO all along, that we'll deleverage the company, which will poise it for a lot of liquidity in future for growth.
You know, you said that how the sector had gone through a long period of a downturn, decade long, and you've come in, turned it around, and in fact, post-COVID, things have dramatically improved. Do you think for the industry and Hotel Leela, a double-digit revenue growth is par for the course from here on?
So again, going back, as you mentioned, the hospitality industry went through a period of you could call it no growth, or in certain cases negative growth. In real assets, supply, demand, and fundamental economic growth matter the most. Now in India, economic growth has been solid, but the demand-supply dynamics for the hospitality sector about 20 years ago got fractured a little bit. Now, as a result of what's happening in the underlying growth, demand for hospitality has changed. Per capita GDP, the rise of affluent and middle-class India, that's all real numbers, and that's now snowballing into what has made India one of the best economies in the world to invest in. So now the demand side is solid, the supply side is very, very muted.
For investors, double-digit revenue growth, do you think it's possible from here on medium term?
As we've disclosed in the financials, we've achieved that in the past, and as I said, the best years are in front of us.
Fair enough. EBITDA margins, 46, 49%, best in class, sustainable?
So there are 2 parts that make EBITDA margins. One is a solid focus on technology, where we've really focused on the revenue management side. At the same time, you have to have your expense control. All of this in a B2C business is aided by how well your customers perceive your business. So the third point in your data that you just mentioned is our NPS score. Our NPS score is industry leading. Yes, we have highest EBITDA margins, but what really contributes is how well our customers in Leela like us.
But margin sustainable, and what do you think is the key reason why your margins are higher than peers? So for instance, Indian hotels, FY25 margins were 35%. Is it just because you are operating in the luxury segment vis-a-vis them, and therefore you're commanding higher average room rents? Is that the explanation for your higher margins?
See, as I said, Leela is a unique business. Our focus is on luxury hospitality. Our focus is an asset-right model. And as I said, our NPS scores drive everything. The second part that we've done in the last 5 years is severely invested in technology, renewable power, making sure our expense control do not compromise the level of service.
We know luxury comes, at a price, but the way the average room rent has gone up, for your company, on an average, it's about 16,000. For the properties that you own, your average room rent is 22,500, and that's not it. The CAGR growth over the last 2 years was 14.5%. I mean, that's double or triple the inflation. What is your view on ARRs from here on?
So I would say, when we acquired the Leela platform, we realized that this brand has the potential to be what came from other countries and became a global phenomena. That does not mean that properties have to be in every country. The brand has to be globally recognized. Four Seasons came from the West, Mandarin came from the East. Both have become globally recognized brand. And that has been our motto to grow the Leela business. In that context, if we compare the room rents today in India, they are still a fraction of most cities in the world. And hence, I believe that for the right service, for the right brand, for the right quality of property, the built environment, this is more of an experience story, not a consumption story.
Yeah. Every hotel is a destination, not just an accommodation, right? At the end of the day.
Every hotel is an experience for lifetime.
Every experience for lifetime. In fact, you're also talking about experience. You're also getting into heritage tourism, spirituality, wildlife. Tell us more about this, because that's clearly high on your agenda.
India is a multifaceted country. In a way, Leela business is a celebration of Brookfield's business in India, which spans almost $30 billion. And the one thing that India has is we are home to 38 UNESCO World Heritage Sites. We have the largest and the most diverse population of the wildcat. Our castles, our forts, our palaces, and palaces at the core of the Leela business. And it was time that we invested back in these experiences, not just in the urban palaces that we have, but also taking this brand. People always talk about when will Leela go international. There will be a time for that, but there's so much scope in bringing international back to India, and not just to the Mumbai, Bangalore, Delhi of India, but to the Ranthambores and to the Bandhavgarhs, Ayodhya.
So today your keys are 3,500 approximately?
That's correct.
Okay, you've got a capex lined up. I think 7 new hotels.
8.
8 new hotels. So the total hotel count would be what, 20, 21?
More than 21. More than 20.
And what would your keys stand at, say, by the end of 2028?
So again, we mentioned what we have currently on the pipeline, but as I said, the momentum behind the Leela business is very strong. It's stronger than ever before. So this is what we have today, but this business has the legs to be even larger.
But your occupancy is low, right? Like 65% vis-a-vis peers. Is that just the price of exclusivity? And are you looking to close the gap?
Look, occupancy and price points are a mathematical equation sometimes. I would say that we have maintained our premium factor. We've maintained the luxury factor. Our occupancies are inching up. And we are not just changing, occupancy levels on the fly. We are making structural improvements into our business, which will allow the occupancies to be sticky. People always say, real estate or hospitality is a cyclical business. Now, how do you make it counter-cyclical? What we are seeing is trend lines now. Post the pandemic, people are staying longer. People are using the Thursdays and Fridays and Mondays as, shoulder dates for extending their, work and, personal travel.
Your positioning has always been luxury. You're not even present in what you call upscale or upper upscale. Right? Is that going to change as you expand?
Ultimately, economics and what you stand for are the two fundamental things that define a business. Sticking to your roots, as long as the business and the expansion plans in that particular segment are in front of us. So we have massive tailwinds right now in the luxury space, almost no competition. And I think this is a great place to be.
So you will stay a luxury hotel?
That's the ethos for Leela.
So just answer in yes or no as we wind down this interview. Double-digit revenue growth, margin sustainable, because the best is yet to come.
The best is yet to come.
Welcome back. You're watching us here on Halftime Report. The market's picked up once again. The Nifty bank up above the 20-day moving average, up around 100 points. Let's get chatting with the management of Solar Industries. The stock's been doing well in today's trading session, especially after the management commentary that came in yesterday, where they are targeting 10,000 crores in revenues, with 30% of that coming in from the defense sector in FY26 itself. What is guiding this optimism and what their order inflows are likely to be? We have Manish Nuwal, who's the MD and CEO, joining in. Thanks a lot, Manish, for joining in. A fairly optimistic guidance that you've given for next year, with defense portfolio crossing 3,000 crores as well. If you could give us a sense on your current order book and what are the kind of order inflows that you're expecting over the next 12 months and what's executable over the next 3 years.
Yeah, if you look at the total order book at the end of the last financial year, it was only 5,000 crores, and now it is around 17,000 crores. Out of this 17,000 crore, defense products are for almost 15,000 crores. So the optimism is coming from that, which is yielding a big confidence in our management that we should do 10,000 crores in this financial year.
Okay. Just wanted to, before we get down to the numbers, just wanted to understand what the incremental order inflow might have been or queries might have been post Operation Sindoor.
We are always watching all the media articles which shows that the Operation Sindoor has been done and our products were being used. So because of the current geopolitical situation, demand for such products are likely to go up drastically. And we are waiting for those orders which can come through the emergency procurement route. Apart from this, we are also expecting variety of products and orders in the normal course of procurement. We have developed many products in last almost 7 to 8 years, and those are starting to commercialize now.
But just if we could get, maybe you can't talk about specifics here, but if you could just give us a sense in terms of the incremental increase in queries or the incremental increase in the possibility of your order book expanding just in the past couple of weeks, and hence maybe your capacity utilization as well.
So if you look at the current situation, it is very natural to receive lots of queries on our capability or to supply the products to meet the current requirement. So we are receiving a lot of queries, not only from India, but from international market also.
Have you closed in on anything? Is there anything certain that you can talk about in terms of orders closing? And if not, by when do you probably expect it to convert from queries?
Those queries are likely to be converted very soon. And I think probably in next 1 or 2 months, we should get the orders.
Which brought me to my first question once again. Manish, you did not answer that. You said your order book has increased from 5,000 crores to 17,000 crores. What I wanted to know is what are you expecting this year in terms of orders? If you could give us a quantum, say, are you expecting 5,000-10,000 crore worth orders? Because defense orders, while they are large in quantum, they are not very frequent, right? You get one, say, 3 or 4 years to be then serviced over the next 3 to 4 years. What are you expecting this year? How much from the Indian defense side and how much of that for exports?
We are expecting, we have already participated in many programs like Pinaka program. We have concluded the few more ranges or few more variants of Pinaka are likely to come very soon. We have participated in air defense programs also. We have participated in many international programs also. So as those will come, we will keep sharing. So we are expecting the order flow to continue in this year as well.
So 10 to 12,000 crore worth order inflow is achievable this year, or will that be an optimistic expectation?
We are expecting huge orders in next 1 or 2 years.
All right. And what about this investment that you've done with the government, or the announcement that you've done, 12,700 crores for drones, etc. Over how many years is this likely to play out? How are you funding this? And what's the expected revenue potential from this?
This MOU we have signed for 12,800 crores and to be invested in next 10 years. But based on our current success of the products, we believe that those 12,800 crores we can do in next 6 to 7 years. And based on the current cash flows, we are very confident that we should be able to meet all these capex program from our internal accruals or little more debts from the bankers. That's all.
And What is the revenue that you expect from that?
We expect revenues over a period. Whatever we invest, it should be at least 1 times or 1.25 times whatever we invest. But it takes time, as you know that defense product takes time to qualify and then commercialization. So it's a long gestation sector, and we are fine with that.
Okay. Understandable. Just wanted to understand that if we were to have this conversation, say 1.5 or 2 fiscals from here on, defense would be how much as a percentage of sales? I think you said 30% eventually, but what would the, say, 3-year plan be for the company?
I think in 26 we should do definitely 30% plus of the total revenue. And as we move forward, we expect it should be reaching to around 40% in next 3 years.
40% in the next 3 years. You know, you have a fantastic order book. You're supplying to the international markets. You're seeing queries increase. What is the biggest risk to all of this, according to you, which you are probably trying to mitigate?
If you look at Solar's business model, the products which we handle are always hazardous or risky in nature. So our company's system has very well fine-tuned to handle these kind of things. And if you look at the global risk, definitely war is also one of a big risk. But from this risk, we are getting these opportunities. Apart from this, if economic slowdown happens or some kind of bigger conflict happens.
But anything more specific in the supply chain?
I think supply chain, we are well tuned because most of our products we are buying from indigenous routes. And in defense sector, 80% plus is from our own captive manufacturing or through our associate vendors. So I don't see much risk in that side.
And this 6,000 crore Pinaka order, when does execution start on that one? Will it be this year or will it be next year?
Pinaka execution should start in this calendar year, probably in Q2, or at best, or in worst situation, it will start from October onwards. So we are expecting the big ramp up for Pinaka programs. Our team is ready, system is ready, but definitely procurement takes some time. So that is the only factor. Otherwise, we have already produced Pinaka rocket for international markets. So we are very confident.
And how much revenue every year will you recognize from this?
I think as of now, we have orders for 2 variants and we expect revenue of around 550 to 600 crores on annualized basis. And more variants will be coming up very soon. So we expect around 900 to 1,000 crores from Pinaka products in next couple of years.
Any associate vendors which you can probably highlight for us?
Because of various non-disclosure agreement and confidentiality, it is not wise on my part to share those names. But we have a very solid relationship with our vendors, and we have been proving those relationships, helping us to company grow on year-to-year basis from last 27 years of our existence.
Okay, all right, Manish, we're going to leave it on that note. Thanks very much for joining in and speaking with us and giving us your perspective. Well, that's Solar Industries. Needless to say, the stock is doing very well. The stock is up around 4% at this point in time, over 14,000 odd rupees for that one. We'll take a short break. Manisha Gupta joins in with a check on commodities. She has with her Ashok Kumar Gautam, who's the MD and CEO at IIBX. Stay tuned.
Welcome back, and joining us on the show now is Ashok Gautam. He's MD and CEO at IIBX. Mr. Gautam, hi, thank you so much for joining in. Would need your reaction really on the latest DGFT notification, which has put gold and silver of higher purity in restriction. What does it really mean, and would that impact business at home?
Okay, so let us make the things clearer for the audience. If you remember, we had this discussion earlier. In the Finance Act, under ITC, some of the HS codes were harmonized. And they had said that this will come in effect from 1st of May. And around that time, Customs came up with their own notifications. And what DGFT has now notified is they have aligned their harmonized system codes along with the Customs code which have been issued. So in this, there is a clarity has been brought in. So now the gold which will be traded through IIBX will be coming under 7108-1210. So and then there is another category which has been notified where the Dore will be coming, that will be under 1290. So this has just been clarified, and this has been aligned with what the Customs has notified as per the Finance Act. So this is one piece which has come in this notification. Second piece which has come under this notification is related to 711011 category, which is platinum, where it has been now clarified that when anybody is importing platinum, that platinum content should be there of 99% purity. As you know, earlier there was a little bit of what should I say, a gap in the notifications where in the garb of platinum, the gold was being imported, calling it as a platinum alloy, while the platinum itself was less than 5% or around that. So that has now been, that route has been plugged, and it has now been clarified that if the platinum has to come in, it will have to have a purity of 99%. So I think this is a very welcome step taken by DGFT, and this will bring in more clarity for the traders, for exchange, and also at the apex level, when the data is being collated, government and Ministry of Commerce and other authorities will be able to find out how much gold has come in the form of bars and how much gold has come in the form of doré. I think this is a very welcome step which has been taken.
Mr. Gautam, also when it comes to IRBX, how was the previous financial year for you, and how is this one begun?
Touchwood, Manisha ji, with the good wishes of all of you, we had a very good year last year, and if it is not out of place to mention, we had a first full year where we had a net profit. That is not so important, but what is important is that there is a trust of the market which has been received. And
what really have been the numbers in sense of imports?
Yes, and the numbers. So we clocked more than 93 tons of gold import last year, and are taking total import till last year to 101 tons. So imagine previous 2 years we had done only 8 tons, and after that we crossed 93 tons. And this also gives us a way ahead that where we'll be going. And this year we have already geared up ourselves. As you know, we had issued a circular whereby we had invited from the TRQ applicants to give us their application so that we are ready at the pre-allocation stage itself. And now when the allocation has already come in, around 1,480 entities have been granted this TRQ quota. And we are hopeful that we will do minimum of 120 tons, if not more, this financial year. Because the more I am now talking to both the suppliers, in fact, I had running meetings since morning with the suppliers as well as the large buyers. They have all been saying that they are now very happy the way customs has supported. The inbound is getting cleared in just 4 hours. The BDR gets created as soon as it touches the Gift City SEZ, within 1 or 2 hours it's ready. We have now from 1st of May extended the T+0 trading hours by another 3 hours. So now we'll be trading from 9 a.m. till 9:30 p.m. We'll be settling BDR starting from 9:30 a.m. till 9:30 p.m. every 30 minutes. And we are also made an arrangement to settle the funds 4 times in a day for the suppliers. So with all these steps taken, we are now seeing a surge of applications which are coming to IBX. We already have around 600 entities, QJ plus TRQ holders, which were with us by end of last financial year. And the 600 applications are in various stages of approval. So I think the signs are very positive for IBX. And we hope to show to the market and to everyone a great year ahead.
Mr. Gautam, as always, thank you so much for joining in and for suggesting those numbers ahead as well. Well, absolutely look positive. And as you said, the last financial year clearly has been very, very bullish for you. And we hope for more this financial year as well. But with that, it's all the time that we have on Halftime Report. But Business Lunch will take all the action.